Hi, I'm here with Catherine Avery today, which is always a pleasure to talk to Catherine, one of my favorite people to have conversation with. Hi, Catherine.
Hi, Leah. Nice to see you.
Good to see you too. It's kind of an interesting week for us to have a conversation. Obviously, we have the escalation of issues in the Middle East. Oil continues to rise this week. Kind of curious what your thoughts are about oil prices and how do you think about that within the context of your portfolio and your companies?
Yeah, well, oil prices are actually up another 8% today, just in one day. So I think this kind of caught a lot of people by surprise because if you think back to last year, we never really got the geopolitical risk that we thought we were going to have. And now all of a sudden, here it is. So, I mean, we're lucky that we came into this with an overweight in energy. And our thought was kind of, well, even if oil prices didn't go up, these companies are definitely returning a lot back to shareholders in terms of dividends and buybacks, et cetera. So, and then they're undervalued. So it was a good place to be regardless. So, but we are happy that we've had exposure there, especially on a day like today, where the only thing in the portfolio that's up are technology and oil stocks. But the energy, believe it or not, filters through a lot of different sectors. And in these types of markets where we're facing a lot of volatility, you originally think that, well, we'll just go to something like a staples, right? Something that's defensive. But actually, that's not working at all. Because when you think about, everything that you need to make a consumer staple good and or to transport the goods, it involves oil. So these stocks are not proving to be as defensive as they thought they were going to be. But energy, obviously having exposure there has been good for the portfolio. And on the other hand, technology, right? Remember technology from last year, which was one of the best performing sectors, and this year started out not to be? Well, technology is actually proving to be defensive because we've had a revision of the value, a reorganizing of the valuations on a lot of these names. They've gotten cheap actually again. And not only that, but we're getting good earnings growth from that sector. We had Broadcom report this morning. That company is just firing on all cylinders, from margins, sales, et cetera. And there's no end in sight to the earnings growth there, and the stock was cheap. So we've gotten a nice bounce in a name like that. We're also now starting to see it with Oracle, right? Oracle had gotten beaten up so badly. It's one of the holdings in our portfolio. But the stock now has a market yield. And it's actually trading at a valuation less than the S&P 500. So,
and that would probably surprise a lot of people. Yeah, I mean it's interesting because diversification. Everybody talks about the importance of diversification, but diversification has not been nearly as important performance-wise over the last few years, right? And so now you're starting to see how important it is again. So we seem to be able to go through these short periods of time where the market or returns are really being driven by one area. And now I keep thinking of 2026 as the year of disruption, not only from a technology perspective, but also from an administration geopolitical perspective. And anytime you see a lot of disruptions, that diversification is really important. And I think energy has been an area that has been unloved for quite a while. So I appreciate your point, and that's where you're seeing the performance right now.
Right. And then hence the market is going to have disruption as well. Yeah. So it's really important to keep that portfolio as diversified as possible. And I think that's what's kind of helped us so far through this year. I mean, so as of last night, we were up about 8.5%. And I think it was the diversification that really has gotten us through these turbulent markets. Any given day we come in, we don't know what sector it is that's going to be up. So, having exposure to technology, having exposure to financials, healthcare, energy, even utilities, believe it or not, all of these different sectors help that portfolio to stay in balance as we move through the volatility.
And 8% return has been fantastic. And it has been a year. I mean, you think about, we talked about some of the geopolitical stuff that have happened. Obviously, you've had some concerns on private credit. you've seen this major correction in software stocks, you've seen the AI stocks trade down. Yet at the same time, the broader market has been pretty resilient. I mean, you've had areas that are performing pretty well. We are in the midst of this kind of great rotation that started, I think, towards the end of November, that continues towards value and towards quality type companies. And obviously, you're right in the middle of that, which is so important. Can you talk a little? And I think obviously one of the big catalysts for that is you are seeing earnings start to rise in other areas. And you and I have talked about this a little bit, but can you kind of maybe talk about the earnings profiles or what you're seeing happen within your portfolio of companies?
Yeah, I mean, we've had a really good earnings season. You know, we always brace when it comes to that time of the year. But for the most part, we are definitely seeing that companies not only beating expectations, but also raising their guidance. And a lot of that is, we're seeing that in our portfolios as well. And I don't know if that's because of the fundamental work that we've been doing, or if it's just, you know, in general, but I'd like to think it's a combination of both. But we're getting some good feedback from these companies. You know, margins are rising, profitability is rising as well. Dividends have been a little bit on the quiet side so far to the start of this year, but you know, companies are still paying their dividends and they're increasing them. And we expect that as we go on later into the year, that we're going to see more of the earnings expectations going up as well. Because one of the things that did not work last year for the economy was the manufacturing sector. We're now starting to see that start to bottom out. And as we go into the second half of the year, which we believe interest rates are going to be coming down that part of the year as well, we're going to see more of an expansion on that manufacturing side. And we have tilted our portfolio more in that direction. So these special situations that we have looked into, we've purposely tried to find companies where there's been a bottoming or a trough in their earnings, and they can take a participation on the upside going forward.
You know, it's funny. I read this great piece, and it was talking about the next application of AI, and one of the areas that they were talking about where we could see the largest impact are companies with lower margins, right? And really see the opportunity to incorporate technology and AI and robotics into their processes, even moving margins up just a bit, has a big impact to the bottom line. And they were talking about the application where you could see earnings growth and multiple expansion, in particular with industrials. So that's right up the line of what you're kind of mentioning. And I do think that's part of the reason that we're seeing this big rotation.
Yeah, and financials too. There's a big opportunity in financials for AI, and for those companies to increase their profitability. It's you know, it's a difficult sector, financials.
Yes.
They did well, you know, into the end of last year, and then coming into this year, you know, with the private credit bug coming through, people started to get a little bit jittery about what's going on there. But you will get enhancements from AI, increasing margins. You will be getting deregulation there as well. So, and you know, sometimes, you know, markets, you know, reach these tops. You're looking for places to go. You know, financials has actually, you know, had a little correction there. So it is a nice entry point if you're not there already.
Yeah, and I think it's also interesting. You've got so much money that's passive. Whenever these concerns come out, a sector gets treated, or an industry gets treated as
Right.
homogenous, right? And they're not. And if you have the opportunity to really do due diligence, and you're a bottom-up stock picker, you have the opportunity to really add alpha. So from that perspective, this environment is really kind of interesting. The volatility is great because it does provide these interesting entry points.
Right, and that's an interesting thought for, you know, passive versus active. When you have that kind of rotation and broadening out, the passive doesn't always really work, right?
Yeah.
So you need to have some foresight into, you know, where this is going to be able to take advantage of an upturn.
Yeah, yeah, and usually they don't from me, so it's interesting to see how the next couple of years playing out for sure. We're talking about earnings, margins, and we started the conversation talking about energy prices. This all kind of gets into interest rates as well. So we have a more inflationary
Right.
variable that's been thrown into the mix of a market that's really been talking about interest rates probably starting to come down in June. I'm curious what your thoughts are.
Yeah, this is like a catch-22 for the Fed, right? So they want to lower the interest rates, but now you have oil prices going up, and oil prices filter through everything. So you're definitely going to see an uptick in CPI numbers and PPI numbers, right? There's no doubt about it, right? We can definitely count on that. And then you have to say, well, where's the Fed going to go with this? Because technically, right, you now have inflation, but on the other hand, this type of an inflationary move is very impactful to the consumer. So we already have a very fragile consumer. Do you really want to stress that out even further? So, I think, the markets are going to have a hard time trying to figure out, where do we go with this? And so for us as portfolio managers, we kind of have to think a lot further ahead, right? Trying to figure out, the next month or two is not going to be the best use of our time, but really focusing on, managing the portfolio to where we're going to be in that second half of the year.
Yeah, I agree. And the volatility is going to be fascinating because obviously the longer this conflict goes on and the less ships that can get through, the longer we're going to have higher prices. If the ships can start getting through and we are able to contain this conflict, and obviously there's a bit of an incentive to do so with the midterms coming up, you would think, of making sure the economy is in better footing than we have had oversupply of oil for a while, and so maybe prices will kind of settle out a little bit. But it is going to be, I think it's really hard to tell. But yeah, looking forward towards the back half of the year and maybe in early 2027, what do things look like is kind of your job.
Right, exactly. That's why, we try and pick out what are the variables that are going to be most important in either moving the market up or moving the market down. And we come back to that, corporate earnings are going up, interest rates are eventually coming down, and those things are probably going to, clear out all the other noise that's going on. And, we could definitely have a market like we had last year. Well, we already have so far. We'll see how it ends. But where, that market climbs that wall of worry through all the chaos.
Yeah, I still think this the secular tailwind for all this AI is really impactful for technology. It's really impactful, and how it's going to continue to play out. Ultimately, I think we're going to see huge impacts, but the headwind is obviously potential missteps from policy or geopolitical issues that continue to come up, and hopefully those are more secular and they cause the volatility, and longer term that we've got the earnings growth. It's fascinating. I appreciate you being on and us getting a chance to have this conversation.
Have a great day.